Welcome to Voyage Daily Tech, the most important news personalized for you every day, supported by Voyage.com.
Today we're sharing 5 stories. First, we'll explore the global race to break China's 85% dominance in battery production, and why new tech from companies like Renault could create a nightmare for our power grids. Second, how a small startup named Lyten is gambling on risky lithium-sulfur tech after buying the assets of Northvolt, a European giant that collapsed under $8 billion in debt. Then we'll cover Figma's blockbuster IPO, which hit a $37 billion valuation after Adobe's $20 billion buyout failed, and why the company now warns AI could threaten its market share. After that, we'll look at how the world's biggest stock exchanges are calling for a crackdown on tokenized stocks from platforms like Robinhood, labeling them a sham. And finally, why the parent company of Temu, PDD Holdings, just issued a stunning warning about its own success, with its co-CEO saying current profits just aren't sustainable. Let's start with a single statistic that might just change your entire perspective on the electric car industry. One country, China, controls 85% of the world's battery cell production and a staggering 90% of the raw material processing. This dominance has kicked off a global race to build something better, faster, and cheaper. But that's not the whole picture. The idea of true battery sovereignty is incredibly complex. Even if we move away from lithium, new chemistries create new dependencies. For instance, some new batteries rely heavily on manganese, and over 95% of the world's high-purity manganese processing is also concentrated in China. So we might just be trading one supply chain bottleneck for another. The current system relies on 2 main battery types. One is high performance but uses cobalt, a metal tied to major strategic and ethical issues, while the other is cheaper but has lower energy density. This conflict is forcing a technological revolution. Startups and legacy automakers are now in a mad dash to break this dependency by reinventing the battery from the ground up. First up, sodium ion. This technology eliminates the need for lithium, nickel, and cobalt entirely. Since sodium is far more abundant, it's cheaper and easier to get. The real bombshell? It can reportedly withstand up to 50,000 recharge cycles. That's 5 to 10 times more than a standard lithium-ion battery. And this forces us to confront an uncomfortable question. Are we just trading one set of problems for another? While that sounds like a perfect solution, the materials for these new batteries aren't magically clean. The mining for alternatives like manganese can lead to significant water contamination and habitat destruction. It makes you wonder if we're solving the core issue or just creating the next cobalt. This is where the situation takes a more complex turn. Automaker Renault is betting on a new chemistry. It claims will deliver the energy density of a high-end battery, the cost of a budget one, and recharge times of less than 15 minutes. They expect it by 2028. Now, get this. A sub 15-minute recharge is both a dream and a nightmare. Imagine thousands of cars in a city suddenly pulling massive amounts of power from the grid all at once. Research shows this kind of unmanaged, ultra-fast charging could increase peak demand on local grids by up to 20%, risking blackouts and instability. Our power infrastructure simply wasn't built for that kind of sudden stress. So the battery tech might be ready by 2028, but will our power grids be? Then there's an even wilder card, Lithium-Sulfur. One US startup claims this technology has more than twice the energy density of what's on the road today, and it also eliminates nickel and cobalt. All of this points to the holy grail everyone is chasing. Solid-state batteries. They promise to be lighter, non-flammable, and hold even more power. But they are still in development, with no large-scale production in sight. This introduces a huge layer of financial risk to the technological race. Hundreds of billions of dollars have already been invested worldwide in building these massive gigafactories for today's lithium-ion batteries. If a breakthrough from sodium-ion or solid-state makes them obsolete overnight, what happens to those huge investments? We could be looking at gigafactory ghost towns and massive stranded assets. The race is on to find the technology that will power the future of transportation. The only question is, who will get there first, and what happens to the global balance of power when they do? We were just talking about the race for new battery tech, and that brings us to our next story, where a small startup is making a huge bet on one of those very technologies. A Silicon Valley startup, Lyten, just bought the assets of a European giant that collapsed under $8 billion in debt. The fallen giant is Northvolt, once Europe's great hope for battery independence. Northvolt's failure isn't just a corporate bankruptcy. It's a major blow to the European Union's entire geopolitical strategy of strategic autonomy, the push to build domestic supply chains and reduce reliance on China. It had attracted backers like Goldman Sachs and a staggering $50 billion order book before it spectacularly failed. Now, the small startup Lyten has swooped in to pick up the pieces, but the auto industry is skeptical. Customers burned by Northvolt's collapse are wary. BMW, which had already cancelled a €2 billion order with Northvolt, delivered a cold response. What really brought this to a head was the backstory of that BMW deal. Reports show that Northvolt was 2 years behind schedule and, critically, was producing far too many reject batteries that didn't meet quality standards. That's the kind of failure that destroys trust. A spokesperson said Northvolt's successor would only be considered for a future project, adding, that is still a long way off. Another car maker admitted they backed away from Lyten just 6 months ago because its technology was only at research scale. However, if you zoom out, you'll see another layer of strategy at play. Lyten isn't just trying to restart Northvolt's old lithium-ion battery factories. Its real mission is to use these facilities to fast-track its own next-generation lithium-sulfur batteries. This is the core of Lyten's massive gamble. They're attempting a two-chemistry strategy. They have to get the old conventional lithium-ion production running just to prove they can deliver, but their real goal is to pioneer lithium-sulfur. You see, a standard lithium-ion battery uses a metal oxide cathode and a graphite anode, but lithium-sulfur batteries use a sulfur cathode and a pure lithium metal anode. This is a huge advantage because it means they don't need critical minerals like cobalt and nickel, which are expensive and have supply chains largely controlled by China. Now, this is an incredibly difficult technical challenge. Lithium-sulfur batteries have their own problems, like a shorter lifespan and something called the polysulfide shuttle effect, which can cause the battery to degrade quickly. So Lyten isn't just reviving a factory, it's trying to solve fundamental chemistry problems inside a facility that already failed once. This all sets up a massive conflict. Lyten is not only battling the ghost of Northvolt's failure, but also the massive head start of its global competitors. One expert put the challenge in stark terms, noting that China spent over $150 billion and nearly 2 decades to build its battery empire. It's a perfect illustration of what the industry calls the valley of death, the treacherous gap between creating a successful prototype in a lab and achieving mass production at scale with consistent quality. This is exactly where Northvolt died. It wasn't a lack of vision or funding, but a failure of execution. Reports point to machinery, malfunctions, inexperienced staff, and a complete breakdown in quality control. Lyten has to prove it can cross that valley where a giant fell. As one CEO bluntly stated, if you think you can shortcut it, then you just don't understand batteries. Speaking of high-stakes gambles, our next story is about a company that hit the jackpot after a massive deal fell through. A $20 billion buyout from tech giant Adobe was abandoned because of intense regulatory pressure. In the aftermath, Adobe actually stopped investing in its own competing software, creating a massive power vacuum. Now, less than a year later, that same company, Figma, is trading with a market value of over $37 billion. Figma is the design software platform used by giants like Netflix and Airbnb. Its secret sauce was its real-time browser-based collaboration. Think of it like a Google Doc, but for designing entire apps and websites. This created a powerful network effect. The more people who used it, the more valuable it became for everyone. And it just had a blockbuster debut on Wall Street. Its share price exploded, more than doubling from its $33 IPO price to hit $85. A massive, undeniable win. But this is where the story takes an unexpected turn. The moment the quiet period ended, the biggest names on Wall Street, JP Morgan, Morgan Stanley, didn't pop the champagne. They hit the brakes, issuing neutral hold ratings. Morgan Stanley's take was clear. Figma is a fantastic platform, but its valuation is so sky high that they're staying, in their words, on the sidelines, and they're not wrong to be cautious. To justify this kind of price tag, Figma is expanding into new areas. Its dev mode is built for coders who now make up nearly a third of its user base, and FigJam, its online whiteboard tool, is pulling in entire product teams. That's why 95% of Fortune 500 companies are using their platform. The hesitation boils down to one core conflict: artificial intelligence. In its own IPO filing, Figma dropped a bombshell flagging intense competition from rapid AI adoption as a major headwind. New generative AI tools, like Google Stitch or a platform called UiZed, can literally create a website or app design from a simple text prompt. This could make the manual design process, that is Figma's bread and butter, obsolete. They went on record warning they could actually cede market share because of it. It's a rare and stunning admission from a company at the top of its game. However, the debate is raging. Other analysts, like those at RBC, see the complete opposite future, arguing that AI could actually be a real tailwind for Figma. Interestingly enough, Figma is fighting AI with AI. The company has already launched its own AI-powered features like Figma Make, which can turn a text prompt into a working prototype, and Figma Sites, an AI website builder. The argument here is that Figma can integrate these powerful tools directly into the workflow. Millions of designers and developers already use, making their platform even stronger. This leaves us with the ultimate high-stakes question. The situation presents a fascinating duality. On one side, Figma is a market darling with a jaw-dropping valuation, while on the other, it's facing an existential threat from AI. And there's one more incredible twist to this story. After raising over $1 billion in its IPO, the company that was almost bought by Adobe could now become a buyer itself, acquiring smaller companies to build its very own creative suite. The former target may have just become the new predator. From one form of tech disruption to another, the world's biggest stock exchanges just sounded an alarm, calling for a crackdown on a new kind of investment they say is a sham. In a formal letter to top regulators, the World Federation of Exchanges declared they are alarmed at a flood of so-called tokenized stocks. Their core accusation is explosive. These products are being marketed as stock tokens or the equivalent to stocks when they are not. The core of the issue is ownership. When you buy a real share of a company, you get actual legal rights, including voting rights and a claim on assets. With a tokenized stock, you often get none of that. You're simply getting synthetic exposure to the price of the stock, like betting on its performance without ever owning a piece of the company. Crypto exchanges like Coinbase and brokers like Robinhood are pushing into this new frontier, creating blockchain-based tokens that are meant to represent shares in major companies. The promise is lower trading costs and around-the-clock trading. But the stock exchanges are firing back, saying these tokens just mimic real equities without the same investor protections. And the risk for the average person is significant. The best case scenario is that the token is backed one-to-one by a real share held in a secure account. But in many cases, some of these tokens are just synthetic derivatives that track the stock's price. If the platform that issued the token goes bust, like we saw with FTX, those tokens could become completely worthless. The conflict is already getting messy. After Robinhood launched tokenized equities for EU customers, including tokens representing shares in OpenAI, the private company itself came out and publicly stated that it did not endorse the tokens and was not involved in the offering at all. This highlights a much bigger, more disruptive goal. The holy grail for some of these platforms isn't just tokenizing public stocks, but prying open the closed world of private companies. For decades, only venture capitalists and big institutions could invest in promising startups. By tokenizing private shares, these platforms want to create a liquid secondary market where anyone can trade them, fundamentally challenging the entire traditional venture capital and IPO pipeline. The exchanges warn this could cause serious reputational damage to the companies whose stock is being mimicked. Now, this fight is starting in Europe for a reason. The EU has new rules called MiCA that create a clearer path for these products than the stricter SEC in the United States. It's a classic case of regulatory arbitrage. At its core, the technology threatens to make parts of the old system obsolete. For example, traditional stock trades can take a day or more to settle. Blockchain could allow for instant settlement 24/7, potentially cutting out the giant clearinghouses that sit in the middle of Wall Street. That's the promise, and that's the threat. So, the battle lines are drawn. The World Federation of Exchanges has formally asked US and European regulators to apply existing securities rules and prevent these assets from being marketed as something they're not. The central question is, will regulators shut this down, or is this the future of investing? And speaking of disruptive models facing serious headwinds, the parent company of Temu just issued a stunning warning about its own success. The co-chief executive of PDD Holdings went on the record stating, quote, "We do not believe this quarter's profit levels are sustainable." Let that sink in This is the company behind the shopping app that took the world by storm. On the surface, their latest report looks strong. They beat revenue estimates, pulling in nearly 104 billion yuan. But that number hides a bombshell. Their operating profit cratered, falling a staggering 21%. That impressive revenue growth came at a huge cost. The company's net profit actually fell to 32.7 billion yuan from 34.4 billion a year earlier. It shows they are spending enormous amounts of money just to stay in the game, and those costs are eating their profits alive. PDD is fighting a brutal two-front war. In China, its platform Pinduoduo is locked in an intense price war with e-commerce giants Alibaba and JD.com. To compete, PDD is pouring billions into merchant support, and it's squeezing their margins dry. The company's co-CEO confirmed that industry competition has intensified further and that profit declined meaningfully. PDD's low prices are actually powered by incredibly sophisticated technology. One strategy is the next-gen manufacturing model, which uses data analytics to tell factories exactly what consumers want in real time. This allows for demand-driven production, slashing waste and inventory costs. It's a high-tech, high-pressure system designed to win on price, but it's incredibly expensive to maintain. Meanwhile, internationally, their breakout app Temu is facing its own intense pressures from US tariffs and a head-to-head battle with Amazon. A major rule change in the US just blew up their business model. For years, Temu benefited from a rule called de minimis, which allowed low-value packages to enter the US, completely duty-free. That loophole is closing. The impact was immediate and massive. After the rule change was announced, Temu's daily US user base reportedly dropped by 48%. To survive, Temu is scrambling to adapt. So what is this fully managed model they're pivoting to? Essentially, it's a huge shift. Unlike Amazon, where sellers control their own pricing, Temu is now taking total control of pricing, logistics, and marketing. Merchants just supply the product. This allows Temu to keep prices low, but it also means Temu, not the merchant, bears all the financial risk for unsold inventory. But here's the killer fact that suggests the strategy might be cracking. A new survey from Omnisend found that 30% of American shoppers have already noticed price hikes on Temu. It all points to a classic business playbook. First, you acquire millions of customers with unsustainably low cash-burning prices. Then, once you've secured a strong market position, you begin to normalize those prices to become profitable. We may be seeing that happen right now. This all begs the question, is the era of impossibly cheap products from Temu already coming to an end?
That's it for today on Voyage Daily Tech. Follow, share, and stay tuned for daily updates coming your way tomorrow.